Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Yeti reported earnings last week, and the results were actually pretty positive. The growth days for this company, being a major double-digit growing company, probably in the rearview mirror for now, but the company is controlling costs relatively well. And except for a one-time cost related to a recall, I think the results were pretty positive. So I want to go over the numbers and exactly what to think about this stock going forward. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you enjoy this video, check out my newsletter, Asymmetric Investing, in the show notes. And I'll start with the earnings release. You can see that sales were actually down on an adjusted basis. They increased 2%, but gross margin continued to expand, and they raised the low end of full year guidance and increased adjusted earnings per share outlook. So I'll get to all these numbers. Here's the revenue, $402.6 million compared to during the same period a year ago, unfavorably impacted by $24.5 million due to a recall reserve adjustment. Without that adjustment, you would have seen revenue up 2% in the quarter. Direct-to-consumer sales, a little over half of the company's business, $226.4 million. I always think that's really impressive. If you can have a direct relationship with customers, that's exactly where you want to be in a consumer goods business like this. Wholesale channel sales decreased 10% to $176.2 million. This is a lot of the channel inventory adjustments that a lot of retailers are making right now. They don't want to have too much inventory on their shelves, and so they're cutting back some of their spending. One of the things I always keep an eye on is the gross profit. That decreased 2% and was 53.4% of sales, just an incredibly high number. And then you want to see this SG&A cost. This is a major component in operating costs. You want to see that remain relatively constant, but that did increase 9% to $164.5 million from a year ago. So there is some added costs, not getting the kind of operating leverage. And long term, that is a concern for Yeti, especially if sales are flat or are essentially flat for the year. Again, those outlook numbers, sales are expected to be up 4 to 5% from a year ago. The previous outlook was for 3 to 5%. So that's what that bottom end of the guidance revision was. Operating income expected to be 15 to 19%, a 50 basis point increase on both of those numbers. And then adjusted net earnings per share, $2.23 to $2.32. That's up from $2.12 to $2.23, which is their previous range. So from a stock standpoint, I think the hard thing for Yeti as an investor is this is still a relatively expensive stock. You can see the price to earnings multiple is almost 60. That's with some of these added costs, but based on the guidance numbers and the adjusted earnings numbers, you're still talking about a stock with a 20 price to earnings multiple. If we look at the data that we have here from Koifin, you can see this next 12 months, their analyst estimates have the stock trading at 18 times earnings. So still a very expensive stock for a company that isn't expected to grow a whole lot, 4 to 5% in an environment where inflation is about 4 to 5%. Not a great deal. This is one of these companies that I absolutely love the product. I love the high margins. I love the brand. But for investors, we have to get in at the right price. And right now, I don't see Yeti's shares trading for the right price. I would love to see this stock trade more like a 10, 12, 13% earnings multiple, especially if revenue is only going to grow in the mid-single digits. You don't want to pay too much for a company like that. And right now, I just think Yeti doesn't have the opportunity to grow either revenue or margins all that much from here. So unless the stock drops, this is just one I'm going to stay out of. But again, very high quality company, but it depends on the price that you pay. And that's what's keeping me out of shares right now. But what do you think? What do you think of the results? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.